Want to know why your mortgage feels like it never ends? It's designed that way. Here's the truth about traditional mortgages. The banks, they love you, but only for the first 15 years. That's because about 70% of the interest that you'll ever pay happens during those first 15 years. That's when they make their money, before you even start making a dent in your principal. Now think about this. When was the last time you actually held on to your mortgage for more than 7 years? 10 years? 15 years? Chances are you didn't. Rates dropped, you refinanced, and at the time you felt like it was a win-win for you, right? You got a lower payment and off you go. But what you don't realize is that every time you refinance, you restart the interest clock. You go right back to the beginning. It's where the banks earn the most and you make almost no progress on your loan. This is the cycle that they want you in, because the longer you delay paying off your principal, the more interest you pay and the more money they make. But there's a smarter way, and I know you know what I'm going to say. It's the all-in-one loan. It helps you flip the script. It uses your income to pay down principal daily. It saves you interest from day one, and it keeps you out of the refinance trap for good. You pay off your home loan 2 to 4 times faster. You save tens or even hundreds of thousands of dollars in interest, and finally make your mortgage work for you, not the bank. So let's take a look at what I'm talking about here. So this is an amortization schedule on a 30-year fixed rate loan, and we're talking about $1 million loan, 30 years at 6.75%. Now I've enlarged this a little bit so you can take a look at it and see. And what I want you to take a look at, this is the year, this is the amount of interest that you pay each year, and the amount of principal that you pay each year, and then what your ending balance is on your $1 million loan after that 1 year, after that 2 year, etc., right? So what I want you to focus on right now is, let's look at year 7. This is about how long people keep their mortgages for. And at the end of the day, what you're looking at is your loan balance goes from $1 million down to $907,000. So you've paid $93,000 of principal in 7 years. In 15 years, let's highlight that column, you're down to $732,000, right? So you're not even close to halfway of paying off your loan. You're $230,000 from being halfway at that point in time. And so what I want you to do is compare that to the all-in-one loan. And the all-in-one loan, this is $1 million loan that we're going to take a look at. And you can see that after year 8, let's highlight, I'm sorry, that at the end of year 7, there's your $92,000 that you've paid in principal. There's your loan balance of $907,000 that you're paid on your 30-year fixed 6.75 interest rate. Probably refinance, or you're about ready to refinance. On the all-in-one loan, this is where we flip the script, right? So your loan balance on this at the end of year 7 is $763,000. So that's the difference between the two mortgages. You're talking about $907,000 versus $263,000. So you've paid principal of $236,000 just by using the income that is going into your checking account and just paying down your mortgage and using it more efficiently to pay down your mortgage faster and still have access to these funds if you need them in any instance, right? On the 30-year fixed rate loan, your principal paid is $92,000. It's not even close. This is after 7 years, right? And if you go to after 15 years, remember on the 30-year fixed rate loan, you're not even close to halfway. So at the end of 15 years, at the end of, let's go end of 14 years. So you're at 15 years, your principal paid is $239,000. Your balance is $260,000. So again, you're still $260,000 from being halfway there. On the all-in-one loan, you've paid, the principal paid is $677,000. Your loan balance is $322,000. You're so close to actually paying off your mortgage on the all-in-one loan versus the 30-year fixed rate loan. And remember that you still have access to those funds. So at the end of the day, that is what we're talking about. You can pay off your loan 2 to 4 times faster, save tens or hundreds of thousands of dollars in interest, and finally make your mortgage work for you and not the bank.